Have you ever really thought about how global trade actually works? I mean, how does a giant piece of machinery get all the way from a factory in, say, Germany to a construction site in Brazil? Especially when the buyer and the seller are on completely different pages about when the money should change hands. Well, we're going to pull back the curtain on something called buyer's credit. It's this powerful kind of secret engine that keeps the wheels of global trade turning. So here's the big question, right? How do you buy something now, but pay for it way later, and somehow keep your seller perfectly happy? It's the classic problem. You want to hang on to your cash, but your supplier wants their money, like yesterday. So how do you square that circle? Is it even possible to get the best of both worlds? Okay, so before we get to the clever solution, we really need to get to grips with the problem itself. It all boils down to what you could call the importer's dilemma. And trust me, this is a core conflict that every single international buyer and seller runs into right out of the gate. And this is it, the fundamental standoff. On one side, you have the importer. They're thinking, look, I need time. Give me 180 days to sell these goods or, get this machine running and making money before I have to pay you. For them, it is all about cash flow. But then you've got the exporter, and they're thinking, no way, I need to get paid now. I've got my own payroll, my own suppliers, and honestly, I don't want the risk of waiting for a payment from a company halfway around the globe. It's a total stalemate. So it really seems like an impossible situation, doesn't it? But this is where finance gets clever. There's this really elegant tool that was designed to solve this exact problem. It's one of those rare situations where you can find a true win-win, something that just perfectly bridges that gap. Let's just put the question out there, point blank. Is there actually a way for the importer to get the long payment terms they need while the exporter gets paid in full, right up front, all in the same deal? It sounds too good to be true, but the answer is a resounding yes. And here it is, buyer's credit. Now, the magic trick, the whole key to this thing, is who arranges the loan. It's the importer, the buyer, who does the legwork. They go to their bank, arrange a loan from a bank overseas, and then use that cash to pay the seller immediately. So think about it. The seller gets paid right away, so they're thrilled. And the buyer gets the breathing room they need to pay back the bank later on. Boom. Problem solved. All right, so that's the big idea. But how does a deal like this actually come together? Let's pop the hood and look at the moving parts. It involves a few key players and a very specific flow of events. So first things first, you've got four main players in this game. You've got the importer, obviously, that's our borrower. Then there's the exporter, the one who's getting paid. They're the beneficiary. Then you have the arranging bank. Think of this as the importer's home bank, the one quarterbacking the deal. And finally, the overseas lender. This is a totally different bank in another country that's actually putting up the cash. Okay, let's walk through the play-by-play. First, the importer and exporter shake hands on a commercial deal. Simple enough. Then, the importer's local bank goes out and finds that foreign bank, the overseas lender, who's willing to fund the deal. Now, step 3 is the absolute linchpin of the whole thing. The local bank gives the foreign lender a guarantee, basically saying, hey, if our client, the importer, flakes out, we'll cover the debt. We've got your back. That guarantee is everything. Once that's in place, the overseas lender wires the money. The local bank pays the exporter instantly. And for the exporter, the story is over. They're paid, they're happy. Then, way down the road, after that agreed-upon credit period, the importer finally pays back their local bank plus interest. It's so simple but really, really powerful. So you might be thinking, that sounds like a lot of steps. Why would everyone go through all this trouble? Well, it all comes down to the incredible power of cash. This setup lets the importer act like a cash buyer even when they're using credit. Let's look at what's in it for each side. For the importer, the advantages are just massive. First off, they often tap into way cheaper interest rates from overseas lenders than what they could get locally. We're talking a big difference in borrowing costs. On top of that, they get that precious extended time to pay, sometimes up to 3 years for really big ticket items like machinery. And here's the kicker. They get to walk into the negotiation and say, I'm a cash buyer. That gives them some serious muscle to negotiate a better price. And the exporter? Oh, for them, this is just a dream scenario. Why? 2 words. Zero risk. They don't have to worry about the buyer defaulting because they get paid in full by a bank right at the beginning. And that means their cash isn't locked up for months waiting for an invoice to be paid. They get their money right away and can put it straight back into their own business. It's just a clean, simple, risk-free deal. Okay, but nothing in finance is free, right? So what does this actually cost the importer? Well, the total price tag is usually broken down into four main pieces. You've got your base interest rate, a benchmark like SOFR. Then the overseas bank adds their profit margin on top. Your local bank is also going to charge a fee for providing that all-important guarantee. And finally, there's the cost of hedging, which is basically insurance against currency risk. And we'll get back to why that is so critical in just a minute.
Now, this is a really important point, so let's make sure we're clear. Don't mix up buyer's credit with something called supplier's credit. They sound similar, but they're opposites. The only thing you need to remember is this. With buyer's credit, the buyer arranges the financing. With supplier's credit, the supplier or the exporter is the one offering the credit. That means with our method, the exporter gets paid right away. With supplier's credit, they're the ones left waiting for their cash. Big difference.
So up to this point, this whole thing sounds pretty perfect, right? A flawless system. But like any powerful tool in finance, it carries some serious risks. And this is where our story takes a dramatic turn. Because in 2018, a huge real-world scandal erupted that shook the entire system to its core and completely rewrote the rulebook, especially in one of the world's largest economies. Before we get to the scandal, let's talk about the biggest built-in risk, the currency. See, the loan is usually in a foreign currency, like US dollars, but the importer has to pay it back using their local currency. So what happens if their local currency suddenly loses value? Well, the size of their debt just explodes overnight. What looked like a cheap loan is suddenly incredibly expensive. That's why that hedging cost we mentioned earlier is so critical.
But currency risk was nothing compared to the shock that was about to hit the system. Back in 2018, a massive fraud scandal broke out in India. It involved a state-run bank, and the criminals basically found a loophole and exploited a key component of the buyer's credit process. And we're not talking about a small problem here. This was a full-blown crisis, and it forced the hand of the regulators. They had to do something, and do it fast.
And a response was swift and brutal. In March of 2018, India's central bank, the Reserve Bank of India, dropped a bombshell. They completely banned something called a letter of undertaking, or LOU. Now, you have to understand, these LOUs were the guarantee we talked about. They were the absolute backbone of buyer's credit in India for decades. And just like that, with the stroke of a pen, they were gone. The entire system was flipped upside down, literally overnight. So, you have to be wondering, did that just kill buyer's credit in India? Was that the end of it? Well, not even close. It didn't kill it, it just forced it to evolve. The market is incredibly resilient. It adapted, and what emerged was a new and, frankly, more transparent way of doing things. Let's take a look at the new rules of the game. So what they did was replace the old lows with much stronger, more heavily regulated tools. Today, banks use things called bank guarantees and standby letters of credit. You can just think of them as upgraded, more secure versions of that financial promise. They do the same job, providing security to the overseas lender, but in a much more transparent and regulated way. So yeah, buyer's credit is alive and well. It's just running on a much safer and more solid foundation now.
And all of this brings us to a much bigger final thought. We've seen the story of a brilliant financial tool that greased the wheels of trade. Then we saw how it was exploited, and finally, how it was reformed by strict regulation. And it really makes you think, doesn't it? In this crazy, fast-moving world of global finance, what's the right role for regulation? Is it just a roadblock that gets in the way of business? Or is it the essential guardrail that keeps innovation on track and actually protects the whole system for the long haul? It's a question we're thinking about.